Alrighty. It's Wednesday morning. Welcome, ladies and gentlemen. We're doing financial modeling on the mobile home park. It's an upgrade. Monday and Tuesday, we did a lot of formatting. The basic idea here is we've added income statement, balance sheet, cash flow statement. Yesterday was awesome. We got through a lot of the tax stuff, which you can see got complicated on exit. We got through all of that. We got the balance sheet to balance through the whole way, except for on the exit. We're going to have to do some work today. That's what we're doing mostly today, but it's pretty solid. And the balance sheet annual, we'll update that. Cash flow statement, monthly and annual is all done. And all this is dynamic based on, this is a model to plan out the acquisition and or development of up to 40 mobile home parks and see what their operations look like. Um, there's it can be a single owner operator, or you could do a joint venture with these, depending on your waterfall options and the hurdles here, as well as the contribution of GPLP. You can also do different debt structures for each one. And if you do have debt, there'll be an initial loan which will have the same terms. And then you could choose yes or no on refi. And if you have a refi, there's refi terms there. And all the loans have options for interest only periods as well. So this is a really good out of the box financial model for mobile home park operation, acquisition, and exit. There's assumptions that drive globally, but there's also individual assumptions that all those things apply to, and all the timing is taken into effect. So it's a really awesome model. This is one of my ultra templates. I mean, it's a $175 one-time fee. I've only got like 3 or 4 of them out of the 130 or 40 that I've done. So today we're going to finish this thing. Before I forget, don't forget to check out smarthelping.com. The mobile home park that we're doing right now is part of the industry specific category. And you can see it's the third one from the bottom here um, for 175. You can get all these templates for 499. And don't forget to check out all the financial models here. We've got a lot of HR trackers, accounting tools, a lot of startup models, joint venture waterfalls. You can buy in category, you can buy in bulk here. You can get all the templates on the site for $9.99, and the value there is immense. All this work is high. Like I couldn't guess how many billable hours worth of stuff that's gone into the research and development of this, but it's got to be hundreds of thousands of dollars worth of billable time. So the value here is super high for any of these bundles, and you know, check it out. All right, so today, here we go. Uh, Balance sheet. Let's get focused here. Um, so we're balanced out, and once I finish this, we're gonna start changing to the assumptions and make sure everything still balances. Okay, so what it looks like is we are out on the last 2 months. Right now, I think I set it to end in November. Let's see what if we end on the last month. We're still out. Let's go back. This just allows me to test a lot of different stuff. Okay, so let's look at this. We're out by $8,270,000. Let's look at our income statement. See if we could find that number. I don't see it. Cash flow statement, maybe. 8,000. I don't see it. So this is a tricky. I thought this was going to be pretty easy. What could we possibly? So the hard part is, and anybody who's ever done a balance sheet knows, it is a puzzle, especially and on this one in um, the mobile home park one was. a little bit of a different structure. So I've basically been having to do all of this logic manually, even though we did import, so we had some formatting, but I've had to build all the logic between these. And so we've got another puzzle here. The question is, what are we out by? So when we're exiting here, we're essentially saying that there's no more, these are being sold, the all the properties. So this technically should go to 0. Depreciation should also, oh, is that the difference between accumulated depreciation and current assets? Yes, it is. Okay. So these should just be at 0. And that's because we've closed them out in our, you can see in our depreciation schedule, um, when we exit, all depreciation stops after the exit, but on this exit month, say it's in November, we do count depreciation for that period, and then we sell. So if you look at the income statement, everything's being sold off, so we have to close that account out. So all I need to do here is a formula that says if and only if there's an exit. So and if our month equals the end month here, and our exit cap is greater than 0, it means there's some value there. Because you could have an end month but no exit cap, and then therefore you wouldn't zero out anything because you're just showing the operations through the end of the period, but there's no exit. So there's the properties and everything are still on the balance sheet. So if this is true, if that's greater than 0 and that equals that, then we want to show 0, otherwise just sum everything up. Okay, and that should be simply a drag over. And then we'll do the same exact function. Oh, hold on. We got to do if and this is greater than or equal to. Drag this back. The model does go out for up to 16 years, monthly and annual summaries. All right, let's do the same thing here. So I want to do the same check, essentially if and greater than or equal to the end month, as well as the exit cap being a positive value or value below above 0. That means we should zero this out. Otherwise, do your calculation you've been doing. Oh, whoops. Then 0, otherwise, there we go. Perfect. So we're now balanced there. The real test is going to be doing this, changing around some of the timing and making sure everything balances. All right, so that says, we're selling all these assets, taking the depreciation, accumulated depreciation, so these counts 0 out, and everything else stays the same. So these shouldn't be going up 430. Oh, this is the exit, so then it should be the same from here on out. And you can see if for whatever reason I wanted to end it in this month, be in there. This is the actual end month. And this cash is assuming the net exit value and all that and after tax and everything. Okay. All right, looking good. Now the trick is going to be the annual balance sheet. Let's try and figure this one out. So we're adjusting here. Let's make it match this. So we just have cash, non-current assets, property. We don't have any of this. And we'll clean up the spacing after we're finished. So what I want this to equal is we're going to index here, but then if it's meets our criteria for the year, we're going to have to show a 0. So hold on, let's see how we want to do this. So I just want to index the value on the balance sheet, just match it with e-date this, comma 11, so the end of the month, the last month of the year, and match that with our months here. Okay. Then we drag that over. So, and then accumulated depreciation, same calculation, but we're going to pull in. Let's get this out of here. Holy cow. We're going to pull in row 34. This is a contra asset, accumulated depreciation. And then we can drag this across. Total assets is just this plus that plus that. Okay, long-term debt, we're going to do the same calculate. Oh, we got to update the cash calculation as well, but another index, just pull in, and then we want 41. And you'll see this a lot if you're doing three-statement modeling with anything really. The balance sheet annual will always use index, or almost always, relative to the monthly, and the monthly is where all the actual calculations happen. Unless you're doing the annual only, then it'll be different. Oh, let's sum this up. All right, long-term debt, so it's based on all the financing activities. Here again, so for equity, we just have one equity contributed row. And you can see on the assumptions for build out, you it let's see, where is it? So this defines the total cost, and the actual equity is based on how much financing you're going to do on each deal, which would be based on the LTV on here. This so D13, I believe. Let's make sure. Yeah, D13. So it's the total acquisition slash development cost times whatever LTV you get, and so that's the loan amount, and then any remaining would be equity, and it could be different for every single mobile home park. All right, so here again, just the index formula. And we'll pull 47. All the way across. All right, retained earnings. Clear this out. We'll pull retained earnings from balance sheet as well, 51. So you see the only thing that gets tricky on the annual is when you have a partial end month. On the assumption, if you're assuming this not fully to the full year end, then we'll have to, well, you'll see. Owner's equity is just retained earnings plus common stock. Liabilities, owner's equity. Okay, these are just checks. Now, we do have to update the cash. So cash is going to be 11. Yeah, you see our variance is going to be in the end year only, so everything else matches, which is good. Let me double check here real quick, make sure I've got audio and visual and everything. One second. By the way, I haven't checked the chat in a long time, but if you guys say something, okay, it sounds working. I will try to respond and interact. So let's get over here real quick. Let me see. All right. Nobody said anything. So we are obviously not balanced in the end here. We would be if we make this the last month of the year, I believe it would balance out. No, it still doesn't. So in this case, what are we doing? We are showing this as not being 0. So what we have to say is if this year equals this, then 0. And if, and we'll have to call this a year of C5. Okay, so that's done. So that matches now. However, now let's look at, let's say, arbitrary end month earlier. Now we're probably going to be out. Oh, wait, we're not. Now, why? Probably because I just have these going. Let's see. 263, 406. Okay, that matches, so that's fine. These are both zeroed. 263, 406. All right, so that's good. Let's try, what if we say no exit? We put NA here for exit month. Now what's, so we still have numbers coming in here. That's a good sign to the waterfalls. Cash flow, okay, good. Yeah, no exits, no exits. Balance sheet, we do have an error or there. So what's this? Here we go. We'll just do an if error, then 0. Does that fix it? Yep, perfect. All right. So we can end arbitrarily, or have no end month. We can have an end month. What if we put no exit or no exit cap here? Okay, so we have a variance. Let's go to the monthly first. So no variance on the monthly. We do have a variance on the annual though, and that's just this 146. So if that equals, if your this equals, we probably should do the if and on this one. If the year of C5 or R5 equals control E5, E7, and 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 this is greater than 0, wait, let's think about this. Hold on. Hold on, hold on. So right now if we're returning 0 and we don't want it to because this is 0. If this is 0%, there's no exit. Or really if this is NA, if this is NA, so we're throwing an error if this is NA and this is 0. Is this what the error was? No. Wasn't that? Where was the error getting thrown? Oh, on the annual. So the monthly's good. What do we do here? This is just cash flow. This is just going. So I did if and control is greater than or equal to D7 and control D8 is greater than 0, then mark it 0. So here we don't want it to be 0 if our exit cap is 0. So let's put the and back in. So this is equals that, and this is greater than 0. Then 0 it out, otherwise don't. Okay, so that checks out. So that's good there. There. Let's make sure. Now let's see. What if we put a partial end month? That looks good. Looks good. What if we do some exit cap? Balanced, balanced, and then let's see. What if we go NA? So there is no exit. 0. That just runs into perpetuity. Nice. Okay. Looking good. Looking good. Let's try a previous year or the second to last year as the end month. These are all things I got to check to make sure. Okay, so there was an error. So this has got to be if and this is greater than or equal to. I told you the annual balance sheet's always going to be the hardest to get to match up. Okay, so that's fine. Let's check 0%. No exit. We're still balanced. Okay. Long-term debt. So we are saying end month here, but we're not paying off any debt. So this principal repayment should not happen. Where's our amortization? Oh, this is going to be a tough one, actually. Because this is assuming we pay off. Let's go to payoff. So if it equals that, then amortization. Oh yeah, that's doing the payoff automatically, no matter what. So we can't really. It's going to pay off that debt whenever the end month is, no matter what. Which, if you're not showing an exit value, then we're just not going to get the right calculation. So I think we have to assume whenever this exit happens, you're going to be selling. And I guess in normal like startup models, this is more relevant to have that configuration to keep seeing it running. But with a mobile home park, when you have the end month, you're going to sell. There's not really any. You're going to just see whenever that is. It's going to be there's going to be some value there to sell. I guess the thing that you would say is if you just want to see operations for 5 years and no exit included. I mean, I guess in that case you have to finesse it a little bit, like put your end month. Let's say you just want to do like a 5 year. You'd pick the end month. It would only run for that amount of time. So like in this case, 5 years. And I don't think there's any easy way we can make this amortization not pay off whenever that exit month is chosen. because it's this number. It's based on this number right here on the refi. Now on the regular, let's say there's no refi. Hold on, let's say there's no refi here. So now we go to amortization. Still 5 years. It's assuming now it's assuming this. Okay, so this one. And this one. And I'm not going to try to modify that formula because it's working really good right now how it is. So it's just going to assume that debt service is repaid whenever you hit the end month. Okay, so, and that's fine. That's just how it's going to be. Oh, why do we have number errors? Oh, because we're just ending without an exit. You're still actually a bit underwater in that case. All right, go back here. Put this back in. So, I mean, the good thing is our balance sheet is looking pretty good no matter what happens, which is good. Let me go back and let's just make sure this is good. Oh, wait, hold on. If we mark NA, I think that, does that do it? No, there's still repayments happening on the end month. Oh, wait, no, there's not. So if you mark NA, it just does the regular schedule. So you could do that in that case, and it would just show you operations for the full time, and you could just cut off, you could just see the forecast at whatever month you want to stop at. You could just stop it there, and it would work. Okay, so that's good to know. Yeah, see liability still showing up here. Perfect. All right, so if you don't want to show any repayments or exit value or anything, just hit NA here and it'll override everything and it will be perfect. Otherwise, you can choose a month and the exit amount. All right, let's double check. So if we do the year before, is our balance sheet still good? Yep. And partial of the previous year. Nice, nice. No issues. Hit yes on the refi. Still everything looks good. All right, we're looking awesome here. We are looking awesome. Give this a border. Now we'll do some overall sanity checks. So let's go ahead and put that. So sanity check. Monthly balance sheet, annual balance sheet. Oh yeah, and we also need to add taxes into the monthly details. That'll be important. So these we want to see all zeros. That's the goal. So let's sum up monthly check here. annual check. And then what else we want to check? Income statement. That would be this number here. That should always be 0. So that's all the main checks on the financial statements. Now we want to see, so let me look at this waterfall. What are we summing up here? Annual detail 1906. So this needs to take into account, I think the only thing we're not looking at is taxes. And if I add that, we should be able to completely reconcile what's happening here with what's happening on a monthly. So we're going to add this in. Let's see, where do we want to put this? I guess, and there's already a lot of checks within this to make sure these are working good. We'll go taxes, monthly, and just drag that over. And this is mainly just a check on all of these, just to make sure we're matching everything that needs to be matched. Okay. So taxes, and that should flow up, but let's do the annual real quick. So 1923. So there's taxes. And that should flow to, let's see, it's not going to matter until we get over to the when there's actually taxes happening, but it could be an effect of, if you're running some profitable operations, but you're also still building, we need to show that tax amount starting to come out of cash flow. So potentially it could raise equity requirements, which is important. So where's our main cash flow line? Operations, loans, refi, debt service, acquisition, exit proceeds. And then equity distribution. So here I believe we just need to add in, so equity contributions. So if, let's think about this. Loan, if 1888 net operating income less debt service. So this is where it goes. And tax. So here's where we just simply go operations less debt service less, and actually it's coming through as a negative, so plus this tax row. And so all it's really going to do is, when it happens, let's see, 720. So it's just reducing operating cash flow. You have that big one here, but then you've also got, so this is not a contribution requirement because we have a net positive. So let's look at the waterfall, how this treats it. We can widen these all out actually. So you've got contribution, but also the repayment rate on the same month. So what are we saying there? We don't really want that to affect the percentage of distribution. We don't want it to go back up to tier 1. So in this waterfall, we'd have to adjust. Let's see what this waterfall would, because these are all essentially, these are all different. So you can use these different types of waterfalls. This is a hard preferred equity. So this wouldn't matter. It would be fine here because it's just saying, 117 is coming out. But it's coming back with this, so it's just a net here. And this just has a pref return. These aren't really contributions, so I'm going to see. In other startup models, I have it a little bit differently, so this isn't ever an issue. But here, this is showing as a contribution, and we don't really want that. It's a tax amount, but it's only taxed after you get the money for selling everything, so it shouldn't be considered a contribution. And then here's just a preferred return model. So what I need to figure out is, let's look at this. So this, I guess it would really only be relevant on the exit month only. So here, let's see. We need to show it somewhere because it has to match the cash flow, but just trying to think how to set this up without impacting our other sheets here. So distributions, this is fine. Okay, so I know what I can do. On here, instead of adding E1923, we're going to just add the taxes from operations only, which is this number. Let me make sure that's coming through as a negative. So this is tax on operational activities. 1, 2, 3. Let me just make sure here. So this 3.1 million tax on operating income, taxable operating income of 8.8. So that looks right. So it's a positive value here. So when I go over here, we're going to actually subtract this. All right, we're making progress. Let's drag this back over. Okay. Now, why is this a bit higher? let's see, where's operations? It's the same. Debt service is lower. Because, so why is this lower? Well, what's the term on this? 30-year, 20-year term, 30-year term. Just trying to see why our debt service is so much lower. Okay, so we're summing up principal plus interest paid. Or we're paying a bunch of principal payments off. Let's see, why would it be lower? So this makes sense. It's the same, it's the same, it's the same, it's the same. Then, is this, what is this? It's not exactly half. Then we're exiting, we're paying off. So that should only be taken into account. It's not taking out the principal. Oh, I see. We're including some of those principal repayments in this. I see. I see. Okay. So that's fine, because that's going to show up down here. Okay, so this is good. We're taking out these taxes, and now what I have to do is, so we're going to have to separate this out. So this is tax on operations, and then we also want to show tax on sale as a separate line item. And so tax on the sale is going to include proceeds plus anything applied here. So there's only 3 tax lines. Now we should have all the tax lines. And this is operations there. Okay, and then now on here, we don't have to reference income statement, just so it's easier to see. You can see right here, it's going to be minus this value. Okay, okay, okay. And then this 147 million, so here's the distribution of the 482 total exit proceeds, paying back the debt service, but this should subtract from taxes. So minus this right there. and then we're good to go. Oh, no, 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 not circular reference. That's what we hate to see. That's the worst thing we can see right now. So that means something is referencing this data here to figure out the tax amount. What am I summing up? So I'm summing up all of this. Oh yeah, because all of this is going to go into figuring out what the tax amount is and the exit. So that references this. I can't also and the taxes also reference this. So it doesn't work. What I would have to do is say, we got to put in one row here. What I'm going to do is say exit proceeds and then net exit proceeds after taxes. We got a lot of logic going on here. Now, all of the waterfall tabs, I guess I could just reference one row down. It wouldn't be too big of a deal. But we're going to have to make sure the cash flow statement, monthly detail, and all the waterfalls need to all balance because it's all showing the same activity, just in different ways, in different formats. Come on, don't crash on me now. Please don't crash. I don't know when is the last time I saved. Please don't. Oh, thank the Lord. Let me save real quick. So I'm going to go net exit proceeds. And it looks like this is actually a summary here. So this is the only number I need to worry about going to the waterfalls, which it should already be doing. So I can put these in here. Just go this minus this. And then here, all I want to do is replace this calculation with this one. Okay, there we have it. So now there's no contributions here. It's just the exit value takes into account taxes. That's what we want. We are showing the operations less taxes here. That makes sense. Now let's go to the annual, do the same thing. So we're going to have to add taxes on. Actually, I can just sum it up. So on the annual, I can just go, let's make a space here. So first of all, I want this to subtract from this amount. Taxes on operations. Tax on sale. So 1926. Okay, and let's go back over, make sure this is all right. What happened here? All right, the equity requirement, this is, what did I call this? Net exit proceeds. Okay, and we just take this minus tax on sale. And this is just summing it up. So let's just double check. So this minus here minus debt service plus exit proceed. Oh, wait, minus taxes for operations. Okay, so that balances. That's good. All right, and then that should be used for distributions already. Perfect there. Now we don't get any weird contributions in the exit month or a year on any of these. Awesome, awesome, awesome. All right, now let's do some checks. Oh, so cash flow. So this is going to be a little bit different. We're going to have to add in some taxes here. And it's not by type, so we actually don't need any of this. We can just do taxes, net cash flow after taxes, and pull this right in. And that is this minus this. And that can have its own internal rate of return, a little bit lower than the project with before tax. All right, so that's our number. Let's look here, make sure. Just so 353, 612. The cash flow balance will show that number plus any equity contributions should be the result. So this is taking a 185. Let's just check the math here. Okay, 185, and that is pulling from here, which is taking all of this stuff. Taxes. Oh, hold on. Now this, so here's an issue. Cash from operations is not counting this, but the equity contribution is. So actually, we got to separate this. We got to subtract. Oh wait, we don't want to double count it. Hold on. So this is looking at. So the number that matters, equity distribution and contribution, is accounting for the tax row, which is taking this. So this is just pre-tax. Okay, so that's fine. What is this not balancing? So this is not counting taxes. So this actually subtract out this, and then what's this doing? And then it should actually match. Let's make sure. Okay, nope, that didn't work. So what is going on here with these? Let me subtract them, make sure it's not just a rounding error. Oh no, it's definitely more than a rounding error. All right, that's off by a bit. So they should match up. So what is this? This is taking debt service, principal, operations, all of this. What if we just, well, no. And then what's this doing? It's taking this number against equity distribution. Let's see, G916. So the total cash flow minus 0708. Now this is taking into account taxes, and this is not. So I need to subtract our taxes here. Wait, maybe just the top row of taxes. Because I think the other ones are included in this calc. Let's try that. Nope. Okay, so what is this check? And what are we out by? 147,592. Oh, it's just this tax amount. Okay. So do we subtract this? There. Let's put this back to equals. True. And that's it. I thought I did it in the first place. I don't know why, what happened. Okay, great. So that just means our total equity requirements and equity distribution matches the total cash flow activity. Same thing here. Now what I want to do is let's do some more checks. So I want to say waterfall 1, waterfall 2, waterfall 3, and we should be able to sum up all of the activity here minus ending cash position. And this 37 million should then equal the sum of equity contributed, which would be this. Well, actually, no. It would be this. All right. Wait, do we minus it? Hold on. Perfect. So that's good. So what that means is, so let's do that for all three. So this is 910, 910. Okay. So here it was 1112. Here it's 910. And after we finish these sanity checks, we're gonna be all set. What is going on here? Waterfall F9 to U10. It's E. It's E. It's E for these two. And then probably goes out to V. Let's check. T. E to T, and this was F to U. FU, and this needs to be E to T. All right, what in the world? Well, we have a variance. Is it real or is it just... Oh yeah, we're way off. Okay, so what the heck? I want to sum waterfall 2. I don't know what the heck I was summing before, but this is what I want. What the heck would I do? E9 to T10. Oh, I was doing waterfall option 1 before. Okay. This is 3. All right, so good news is that all matches our balance sheet cash minus, and then it assumes, because the balance sheet's assuming the equity contributed adds to the cash of the balance sheet. So that's good. So those all match. Is there anything else? Annual detail. Annual detail to balance sheet cash. So this one we should be able to sum up. Let's see what would be the right area. This, and then minus cash. Okay, and plus all or any equity required. Or minus, I can't always remember. Okay, well that's kind of cool. So all of our numbers match everything. So everything happening on waterfalls matches the annual and monthly detail, and everything on the annual and monthly detail matches this. I guess we could do one final check on the MHP detail to balance sheet cash. So you sum up all of this and make sure this whole thing minus cash is here, and then minus equity contributed. All right, perfect. So everything is in line. Put this back, top left, top left. All right, cool. Now we do mess around with the assumptions and make sure everything still has a zero balance check. And then we're done with this thing. And the reason why I always do that is because if somebody comes in here and starts changing the assumptions around, timing and all that, and then they see errors, it's not good. So I need to make sure that that is does not happen. All right, so all zeros. We want to see zeros here on every single anything I change. So let's just start messing with this. So if I zero out these, okay, all good. I'll do that. Let's say we do no refi. All good. All right. Uh, let's say we do no debt on everything. So it's all equity in this case. All good, just lower IRRs. All equity. All right, that looks great. Undo that. Let's try interest only period, let's say 12 months. Good, that's all looking great. Let's adjust the end month. Okay, all zeros. Let's try NA for an exit. Oh, balance sheet, son of a gun. That's always the one. So annual balance sheet, if we put no NA on the exit month, we've got an error. Also, while we're at it, let's just remove all this extra space. Okay, that's cleaner. These are already cleaned up. So why do, oh, what? We're out the whole way. Okay. What happened? Assets. Oh, this is just zero the whole time. So let's see. Index 16, still 16, that's the right one. So if and your C5 is greater than E7 and control is greater than that, then zero. I see, because it's an NA. So on this, so if the year, if it's past that, so that criteria is fine, but we're also checking if D8 is greater than zero. And this is assuming cap rate is 5. I guess we could just put this ahead of everything. We can say if this is NA, then simply just pull the number. Just do this formula. If control D7 equals NA, just do the regular thing. Otherwise, go on. Because NA means there's going to be no clear out of any of the fixed assets or anything. Okay. So let's go back over here. So 0. Let's go back to like an end month. Make sure we didn't mess anything else up in here. This is 0. That's fine. Very likely this is 0% cap and this not be NA. Yeah. So that'll rarely happen. It's not really logical, but if you did, it just shows a div error here. Which is probably because there's a 0% cap rate. So yeah, so there's 0 here. That makes sense. I could quickly fix that. We could just do if error shows 0. Okay, there you go. So now it's fine. Let's put this back, make sure everything still works. Okay. Let's try end month. Let's try NA. Let's try previous year. Nice. Let's try previous year with 0%. Looks good. Let's try partial of the previous year with an exit cap. All right, I think we're good. Because these are the only things that usually break is changing the timing. And that's stuff you can't really tell unless you actually change it. Awesome. So this is done. Uh, fully integrated. We've added the updates are you now have an income statement, balance sheet, cash flow statement that all updates with anything changed here. You've also got depreciation, which will go into the tax benefits you can see with mobile home parks, depending on the useful life. Or you can manually put in your depreciation here on the month relevant to each one. A lot of flexibility. And then basically we further validated all the logic going on in monthly annual detail and the waterfall. Everything is all balanced with the cash or income statement, balance sheet, cash flow statement, financial statements in general. So that's a great check. And that's all I got. Let's just check a couple last minute things. So refi is no, that's fine. What if I put this at 0? It's fine. What if we do, so this, if this is at 0, or no, if this is at 0, it just means you're not taking any debt. Put this up to 8. All right. Cash flow statement is a nice place to go if you want to see all the different line items that are affecting cash, which is really important in the exit year. You can see all the different things happening there, broken down into the operating activities, investing, financing, and total. All right. Love this. This is really, really cool. Don't forget, if you want to check out this template, go on over to smarthelping.com. It'll be under industry specific models. You can get it right here. industry specific. It's the third from the bottom, mobile home park, or you can search for the top here. And again, 175. I'm going to do the update overview video of this, and that'll be the main video. I'll also update this index tab to include the new tabs that we've done here. This will be a new video, and all the rest of this is fine. All right. Well, this was a big week and last week was a big week too. The manufacturing plant was hard. This mobile home park thing was really hard. But the model's better now, better than it was. There is a light version of this available as well, but it only has 5 total parks instead of 40, and it's obviously not has all. It doesn't have all the upgrades. The upgrades are only going to be in the 40 park version. It's not too hard to slim down. You can just delete. I mean, if you want to delete roads you don't need and throughout the model just to make it lighter. But in general, it's pretty quick as it is. Um, okay. What else? I thought I was going to end with something else. I can't remember. What a great day, though. What a great day for modeling. Um, oh, I don't know. So next week I'll be doing the upgrade to the ratio-driven SaaS model. So this is a model where you're basically primarily gathering customers based on the work of sales directors and account executives. And the whole template runs off of ratios and performance of the account executives. So I really, really, really like the logic in this one. And adding the 3 statement model and cap table is just going to improve it. We're not really going to change any logic because it's really good how it is. But we will add the financial statement reports, cap table, and all that. So that'll be next week. It'll be real smooth. I don't foresee any big um, issues with that, and it's not going to be as hard as the mobile home park or the manufacturing plant. So as we continue along here, this is number 16. The SaaS ratio-driven SaaS will be number 17 of the total templates upgraded, the startup templates upgraded, and we'll just keep going on trucking along this year, having fun. I'll see you guys. So tomorrow will just be the overview video of this, and then Friday I'll probably, unless I find some cool like single template calculator I want to build, I'll probably be off, and then we'll be back Monday for the SaaS